Hiring kids as a tax strategy is one of my favorite all-time tax strategies. We're going to talk a little bit about it today about unlocking tax savings and financial literacy and other benefits of how this all comes together. I'm Neal, Chief Tax Strategist and founder of Tax Sherpa. So without any further ado, let's just dive in. So why do this? Why hire kids? Basically, there's a few different reasons. One is tax savings opportunities. So obviously, we are in the tax game. We want to pay as little as we possibly can. And by implementing tried and true legitimate strategies, that's all great. But the reason I like the hiring your kids strategy so much is that there's a lot more than just the tax savings. There's also benefits for early financial education for the kids. There's long-term financial planning. There's a whole bunch of ancillary things that come along with this particular strategy. First thing you got to do is set it up correctly. So when it comes to hiring your kids, there's two options basically. One is a partnership in which the partners are the parents of the children, and the other is a sole proprietorship or a Schedule C. So always, if we can, we want to do the Family Management Partnership LLC. And the reason for that is that Schedule Cs are horrendous. They're huge audit targets, and I'm not going to get into all that as to why, but basically, a Schedule C has a 10 times higher likelihood of getting audited versus a partnership or an S corporation. And that's just because when the IRS does their analysis, that's where they think the money is. And I'm sure you've heard the news that the IRS is hiring tens of thousands of new agents. They promise up and down that we're only going to target people who make $400,000 or more. But one, we're not clear if that is a net or a gross number. And two, they're lying. So we want to minimize our audit target. So by shifting this off onto a partnership, it's going to be better off for everybody. So the reason those two options are the options is that when you have a sole proprietorship or a partnership, you end up with self-employment tax impacts. So that's payroll tax, Social Security, Medicare. And because of that is what enables the exemptions from Social Security and Medicare to occur for the child employees under these structures. So if you pay a child between the ages of 8 and 18, then, and it's under one of these properly set up structures, then that child's wages is exempt from Social Security tax, Medicare tax, federal unemployment tax, and in most cases, state unemployment tax. And then the income tax portion we'll address here in a little bit. So bringing the kids on the payroll, key considerations, optimal ages is 8 to 18. So once they get older than 18, you lose the exemption for the payroll tax, the Social Security and Medicare portions. Under 8, basically court cases have found that they are not capable of substantial activity. They're just too young to be employed at any job. And I know as every time I say that, people say, my buddy said, or I heard that if I put my baby's picture on my website or on my business cards, that I can pay them as a model. And it's maybe, okay? But realistically, how much is a baby or a toddler or whatever going to earn for 1 hour of photo shoot during the course of the year? It's not a lot. So if I said my kid was a model and I paid him $15,000 for that 1 hour of sitting there, that's not gonna stand up to any kind of scrutiny. So what we want is real jobs doing real work. All kinds of things can be done by kids. Kids are way more capable than you might assume. When they're on the younger end, that 8, 9, 10 area, usually it's going to be like office admin kind of stuff, janitorial, things like that. As they get older and more capable, then they are going to be, or I often recommend a lot of times, shifting more into social media, competition research, all that kind of stuff. We have got several clients that their kids actually run their social media programs just entirely, and they become their social media managers. And that's great. That's actually a pretty high paying job when you look into the specifics. And then the question becomes how to pay them. So here's the thing. Everybody wants to do everything on the cheap. And I see this bite people in the ass all the time. So do not file your payroll yourself. Hire one of the third-party providers like QuickBooks Payroll, Paychex, ADP, Gusto. There's a million of them. Even if you go to your bank, they'll probably do it. And fees are going to vary. You're probably looking at 50, 60 bucks a month, somewhere in that range. But every single person I've seen try to do it themselves has screwed it up, either done it actually wrong and or not been able to keep up to date on the filing deadlines. Yeah, just go with one of the third-party providers. Internally, we use QuickBooks a lot just because it's already integrated into the bookkeeping. That's easier, and the prices are competitive. Even the other ones, the ADPs and the Paychecks and whatever, they'll integrate with your QuickBooks if that's the platform you're using, or if you're using another one for bookkeeping or record keeping, then there's probably a plugin for that as well. The setup is the hard part. Once everything is up and running, then it's pretty easy. But you got to register with to set up any payroll, you got to register with the state. You got to have in most states, you need an income tax withholding account and you need an unemployment tax withholding account. And you got to do all that work. If you are going with a service like ours, we will do that for you. And that's pretty cut and dry, but it does take time and work. If you want to do it yourself, just make sure that you go through your Secretary of State, ask them all the questions of what is it that I need, and then make sure that's all done. And you're not going to need an EFTPS account with the feds because unless you're paying other people under this payroll arrangement, then there's not going to be any tax, whether it's payroll tax or the unemployment tax deposits necessary. All right. So then the next question becomes, where do I get the money? So this is a typical setup that we have. And basically, we're going to have the family management company off to the side, and you're going to have your operating company over to the other side. And that operating company is bringing in revenue, it's spending operations expenses. The money to pay the kids is going to come out of those operations expenses. And that's going to go into the family management LLC, and then it's going to pay out to the kids and their bank accounts. And yeah, they do need bank accounts. One of the things that's underappreciated about this kind of setup is that there's actually a cascading tax savings effect. So one, not only do you get the deduction for the paying the kids, but also that's going to reduce your net income in an S corp, which most of the time, at least with our clients, that's how we have it set it up. And when you reduce the net income from the S corp, then that also reduces the wages being paid to the owners because S corps require reasonable comp wages. By shrinking that amount, that reduces the amount that we need in order to satisfy that requirement. It's a twofer. And we see this a lot in tax strategy. When things come together, the sum is greater than its individual parts. And then managing the kids' payroll, record keeping and compliance. You got to keep records. They have to do a real job. They should have a timesheet. It could be a spreadsheet. You can just write it down, however you want to keep track of it. You use the payroll services, like the Paychecks or whoever. They're going to handle all the filings, and you just input the number of hours during the pay period. And you just want to pay them regularly, every 2 weeks or twice a month, whatever is best for you. Twice a month is a little bit easier than every 2 weeks. You could say like 1st and 15th or 15th and 30th or whatever. You just keep your timesheet up to date. You plug in the numbers, and then it'll take care of the rest. That's also a great way to make sure that you are actually doing the things in a timely manner rather than trying to catch up at the end of the year. Because there are labor requirements. Like most states require that payroll is paid at least twice a month. And you want to be in compliance with all those things. Just pay them on a regular schedule and put in the appropriate numbers for whatever work it is that they did. Tax benefits. Now we get down to the numbers. So what happens is we know already that the kids' wages are exempt from Social Security tax, Medicare tax, unemployment tax. Now, if you pay anybody or anybody earns less than the standard deduction, they're not going to pay any income tax. And you might have heard of the kiddie tax. That doesn't apply here because kiddie tax is for unearned income. So if you're passing investment income through to your kids, then they will have to pick up that tax or that income at the parent's tax rate. So there's no loophole there. But for this is earned income, it's a different category. So in 2024, the standard deduction for a single filer is $14,600. So if your taxable income or your AGI is 14,600 or less, you're not going to pay any federal income tax. You might pay state, depends on the state, depends on the numbers there. On top of that, you can, now that you have earned income, you can contribute to an IRA, or your kid can. So imagine your kid is 12 years old and made $14,000, but you actually paid them $21,000. You paid them $21,000. That's greater than the 14,600. But then they contributed 7,000 of that 21 to a true traditional IRA. That's a tax deduction. So your operating company gets a deduction of $21,000 because that pays through the family management company. The kid puts $14,000 into their bank account, of which we're going to talk about that in a second, but that's where the spending happens. And 7,000 goes into a traditional IRA. So if you got two of those kids, then that's a $42,000 deduction. And let's say you're in the 32% bracket, whether that's federal or federal plus state, whatever, let's just say 32%, that's your marginal rate. And the tax savings on a $42,000 deduction is $14,000. Or if we look at just one kid, tax savings on $21,000 at 32% is $7,000. Plus or minus, there's a couple dollars difference. But effectively, what happens is that the tax savings that you realize from setting up these kind of structures will pay for the contribution to the child's IRA. And now that we have earned income, we can open IRAs and contribute to them. So what happens? So basically, the funding the IRA is free if you do it this way, which is amazing. Because what happens to that $7,000 over the course of a lifetime? Now, most people don't get serious about retirement until their mid to late 30s. We see this all the time. 28-year-old, do you want to contribute to retirement? No. Okay. 42-year-old, do you want to contribute to retirement? Yes. Because they start to realize that time is ticking. The years keep passing by. And I'm in my mid 40s. I've certainly experienced that same exact thing. But we have a 12-year-old or a 15-year-old or something like that putting in money at that age and allowing that to grow to 60, 65, 70. That can be a 50-year time horizon for investment. Now, depending on what assumptions you want to build into that, let's say the kind of typical numbers that financial planners use is 8%. What does $7,000 turn into at 8% over 50 years? Because of the power of compounding over that long time period, the biggest effects of compounding are at the end. So by extending that timeline, we have bigger and bigger effects at the end where it really matters. That $7,000 turns into over $300,000 at that future date. And that's just from 1 year of contribution. You do that year 2, year 3, year 4. If you plan this right, you could get up to 10 years worth of contributions in, and that's going to turn into millions of dollars in a retirement account for your child in whenever the child reaches that age. So it is setting them up for life, essentially. And you also have to work on the discipline of not taking that money out early and allowing it to grow. But that's a separate lesson that we'll get into here in a second. So basically, if you do this in this way, you are making your kids into millionaires for free. Let's just let that sink in for a second. Make your kid a millionaire for free because you're taking advantage of the tax deduction that is allowed to you and then funneling that into a retirement plan. So yes, with a traditional, they'll have to take, when they take the money out, they'll pay taxes then, but time value of money, it's definitely worth more to take the deduction now versus doing it later and doing that same kind of thing with a Roth IRA. So in this particular case, I think traditional is the way to go. And fun fact, IRA, most people think stands for individual retirement account. It does not. It stands for individual retirement arrangement. And that's a critical difference because an arrangement can do lots of things. If you want to get into the self-directed IRA approach, IRAs can invest in real estate. They can invest in operating businesses. They can invest in stocks and bonds and everything. I've seen people invest in tax liens for property taxes, all kinds of stuff. It's not limited to just, I have an account at a brokerage. Not that there's anything wrong with that, but you have a lot more options than that. All right, so let's talk about the additional benefits. And this, beyond making kids millionaires and beyond just the tax savings that we have in the current year, that's all great, but that's same as every other tax strategy. The thing that makes me love this strategy so much is that we get these other things. We get these additional benefits. So first off, you're getting financial education for your kids. Okay, my 13-year-old now has an account with $14,000 in it. What next? You got to start learning the lessons. Okay, there's investment, there's savings, there's spending, there's tax requirements, like what are taxes? We have to file these papers. What is all this going on? And you'll be amazed at how frugal a teenager can become when it's their own money. So here's the thing. Most people worry about, I don't want to give my kids all this money. You're already spending money on your kids. Every parent in the world, hopefully, is spending money on their kids. So now, instead of you buying the camp or the new clothes or the cell phone or whatever it is, now they're going to pay for it. Okay. And it's coming out of their money and they're going to see those account balances change. And all of a sudden, be like, oh, I don't know if I can afford that. So they start learning these lessons early and in a controlled environment where you still have a lot of influence. So it's a great way to start teaching those money lessons to your kids. And obviously, we have the long-term financial planning and wealth accumulation ability with the IRAs and with taxable accounts, because if they don't spend the whole amount, they can save and invest, right? They can give to charity. They can give to your religious organizations, whatever it is. You get all these additional benefits of having them operate their own accounts. And here, I'll give you just two quick examples. These were real life situations. We had one client who's a consultant, and we had already applied a lot of different tax strategies to his situation. His taxes were already low. And when we put his two teenage daughters on the payroll, his taxes actually went to zero. It was a great way to get him that last mile and really affect tax tax freedom, really, for them. Example two is my own example. So I have my 9-year-old. She was doing office admin work. I had her scanning mail. She was opening the mail, scanning it. It goes into the computer. I set her up with a laptop. And then I taught her how to title a PDF of the scan. And then she scanned a whole bunch of mail because I get a bunch of mail. And then she took the papers to the shredder and shredded them. That was the fun part. Still needs to be done. She comes to me, I don't know, a month later, and she found these roller skates that she wanted to buy. Her aunt had shown her how to shop on Amazon, which is, I'd question the wisdom of that. But she says, I found these pink roller skates. I want to buy them. They're $39.99. I have $36. And can I buy them? So first off, you're short of the $39.99. But second of all, the price isn't $39.99. And so I added the roller skates to the cart. And I showed her that when you actually come to pay for the thing, there's this thing called sales tax. Now, I subscribe to Amazon Prime, so we get free shipping, which is great. But it came to 42 something when all was said and done. And then she was like crushed. Maybe not crushed, but she was disappointed. So this was a critical teaching moment for me because, like, one, okay, you had a goal. Your goal has now changed. Now what? You got to build in some resiliency into your plans. Second of all, there's this thing called sales tax. What's that? Never heard of it before. The price of things is actually higher than the sticker price of what because of these extra fees. And third, now she has an understanding that in order to achieve her goals, she has to work for them. And the fact that value creation, or I guess money, comes from value creation. In her case, that's just going to be labor. She's not creating intellectual property assets or anything, but she might be soon. And we want to translate that value creation into money in order to be able to spend that money for things in our lifestyle. That's a pretty high level concept for a 9-year-old to start to absorb. And she doesn't get it 100%, but the process is starting. And over the years of implementing this over and over again, then she will have a great advantage when it comes to going off on her own and working in the world and understanding how money works. So it's those extra effects that I think are so critical for this strategy and why it makes it my favorite strategy. All right. So recap, you get tax benefits, you get the write-off as far as the wages go. We get life benefits with teaching kids all about money, getting those lessons early. We get retirement benefits with being able to set up early savings and investment so that it can grow for a really long time and really work in your favor. So if all this is interesting to you, you should book a tax survey call with one of our tax experts. You go to taxsherpa.com and then click the book an appointment link up at the top, and that will put you on the calendar. So our whole strategy is 4 steps. First is the tax survey. That's what this call is about. So we're going to analyze where you are and what's going on in your tax life. What's your income like? What's your expenses like? What's your family structure like? So we can implement these kind of strategies. Do you have any investments? Do you have properties? Do you have other businesses? Do you have joint ventures? All these kind of things. We get the lay of the land in the tax survey call. Next is the route. So what the route does is it's the map. It goes you from point A to point B. We got to know where we're going. So first we got to figure out where we are. That's the survey. Then we can figure out where can we go. That's the route. And we can say, okay, under current situation, you are paying X dollars in tax. Under where we can go, you're paying Y dollars in tax. And Y is tens of thousands of dollars less than X. And that's often what we see with our clients, tens of thousands of dollars worth of savings each year. That's the critical part. The third step is the trek. Now, the trek is actually doing the work. You can't just look at a map. You got to go from point A to point B. And that's where we start implementing all of the tax strategies. And the fourth step of the 4 steps is the compass check. So the compass check is checking up because things change. The only constant in life is change. The plan that we made at the beginning was with that information that we had then. And now we are some point in the future, things have changed. Numbers have changed, projections have changed, everything has changed. So we always have to make sure that we update our route, update our trek, and make sure we stay on course with the compass check. So if that all sounds interesting to you and you want to improve your individual tax situation, go to taxsherpa.com and book an appointment to talk to one of our tax experts. We'll see you there.